Okay, so we'll talk about the so when we were talking, well, tonight's topic will be on what's called the volatility smile. So a smile is basically a graph, a two-dimensional graph that looks like a person smiling. So they call it the volatility smile. But anyway, so some of the questions, what we now have is we have with the Black-Scholes pricing model, we have a model to figure out a theoretical price for a stock option. Okay? And the question is, if we looked at the real market, hopefully the theoretical price and the real price should match up, otherwise there's something wrong with the theory, right? So when we go to calculate the price using this theoretical model, a few questions come up. How close is the market price of an option to the one predicted by Black-Scholes? Do traders really use the Black-Scholes when determining the price? And are the probability distributions of the assets really log normal? So that's all the assumptions we made in doing the real price. I'm sorry, the theoretical price. Now, if we were to look at the real stock market and ask ourselves how close are we, and if everybody who is in the market used this model, then this would be the price, because everybody would be targeting that price. And if it went out of bounds, then people would buy on the other side of what the current price is compared to what the theoretical price is, so it would keep going back to this model. So now the question is, how close, is this Black-Scholes, does it perfectly match the market, or how close is it? Okay, so the implied volatility of the Black-Scholes model is the value of the volatility that makes the Black-Scholes price match the market's price. So therefore, the implied volatility comes from the market. So what I'm saying by that, and it'll make a little more sense when we go over an example. I'll go over an example in Excel shortly. But one of the parameters, which was the volatility, sigma, is something that we had to, with the Black-Scholes model, we had to somehow make up. We had to say maybe based on the past, or the past week, or the past month, how volatile the stock was. We would then say, okay, with that level of volatility, I can now calculate the Black-Scholes price. Okay, so just some side facts about coming up with the Black-Scholes price compared to the real market price. Recall the put-call parity for a European option. It basically says the put price plus the current stock price discounted, and then we could also add in a dividend if we wanted to, equals the call price plus the strike price discounted with time. Now, if we use the numbers that the price of the put and the price of the call, if we use the ones that came from Black-Scholes, we could just rewrite this formula using Black-Scholes formula. Okay, and again, this Q would be if the interest rate, if you had to calculate in a dividend. So this statement should be true. The put-call parity remains true for the Black-Scholes price and the real market price. And then if we did the same thing for the market case, whatever the real market put call price is and whatever the real market call price is, this put call parity should also be true. So that being the case, then if we subtracted this equation from the previous one, we would get the difference between the Black-Scholes put prices should be the same dollar difference between the Black-Scholes and the market call prices. Okay. So the idea, this is it'll never come out like this, but this is where the idea of a smile curve comes from. So basically, any graph, x and y axis, where the graph comes out looking like this is sometimes referred to as a smile curve. And some of the curves might even go downward, which you could almost call a frown curve if you wanted to. But that's the idea of what that would be the idea of what a smile looks like, a curve that looks like a smile. So what we want to do now is we want to say, okay, if we're going to calculate the price of a stock using the Black-Scholes model, what do right now is I'll go over to an Excel spreadsheet. And what I'm going to do is, I'm going to take, first of all, I'm going to use from the, okay, so in this example, I'm going to look at using today's date, which is December 7th, 2011, and I'm going to figure out, based on the Black-Scholes model, what is the volatility, or the implied volatility, of an option, a call option on Google stock for, let's say, 3 or 4 months from now. So what we need, first of all, is the risk-free interest rate. So I'm going to, there's no perfect way to figure out what is today's risk-free interest rate, but I'm going to treasury.gov, and I'm looking at we're going to be somewhere between 3 months from now. It's a little over 3 months from now, March, right? December, January, February, March. No, almost perfectly 3 months from now. Slightly over 3 months from now. So the 3-month interest rate is 0.02, and the 6-month interest rate is 0.06. I'll just take a weighted average and make it 0.03 for today, for today's example. So that's just using the Treasury data, U.S. Treasury, as our risk-free interest rate. And then, okay, so I'll use, for our risk-free interest rate, I'm going to use this 0.003. All right, so that's 1/3 of 1%. Okay, and then if we just go out and get real live market data, we go to, seems like Google Finance or Finance. I'm sorry, Google Finance or Yahoo, finance.yahoo.com. Seems to have a popular place where people go for data. So Google, for example, so the stock price of Google closed today at $623.39. So I have that as my current price. And then, if we click on options, we could look at options, call options on Google around that price. And so here's what we'll end up doing. I'll kind of go over just in Excel how you calculate the implied volatility. But let's say, for example, so it shows the ones that are, these ones in yellow are the ones that are not in the money. I'm sorry, that are in the money, right? The current price is higher than the call price. So you would be eligible to collect money today if you own those stocks. And then the ones in the white are not in the money yet. Okay, so now for example, if we wanted to do a calculation on a call option at, let's say, the price of $6.50. I'm sorry. I want to look at the March of 2012 options. I was looking at this example this morning. I was wondering why the prices are so cheap, and they're cheap because they expire next week of December. Okay. So now for the March of 2012, which actually expire on the 3rd Friday of the month, which would be right here, March 16th. The March of 2012. The option is $6.50. The strike price of $6.50 is currently selling for $29.50. I'm sorry, $27.50. So with a strike price of $6.50, what I've basically done here is, so this is that D1, the D1, you know, that long calculation. Basically, it's I just want to go over this, that it makes sense. It's the natural log. So the D1 term, you remember we calculated a D1 term and a D2 term? Okay, so the D1 term is the natural log of the current price divided by the strike price plus C7, the interest rate plus the, so what we're calling sigma, the volatility is what's in our formula would be sigma. This would be sigma squared, which is this value. I have this box set to this number squared. That divided by 2, so this would be the sigma squared term, times the time, which is this, time until expiration, divided by C5 ends up being the sigma times the square root of the remaining time. So that was our term 1, and then our term 2 was, D2 was D1 minus, I believe it was D1 minus the volatility times the square root of the remaining time. Then the way it calculated the remaining time was if you plug in today's date into a box and plug in some point in the future, there's a, Excel has a function called net workdays. So you could just take, I know, like sometimes in our textbook said some strange things. First of all, it says it's 360 days in a year, right? I don't know if you read the book, and then it says like, take how many days including weekends from now until the time you're looking at, and then divide it by 360. So that kind of takes weekends into account, and that kind of thing. So, so what I'm doing here is I'm taking how many days that the stock market is open, and how many days left in the year until, how many work days is how many days the stock market's open. Now there might be a couple of holidays that this workday function and the stock market don't exactly line up. The stock market might be closed one day that this Excel function doesn't take into account, but it's close enough. So we could take 2 different days and it'll calculate how many work days are between them. And then I took how many work days there are in a year. Yeah.
Do you have this on your website?
Yeah. You'll be able to copy this. So.
Okay.
So I guess I could leave it as, I'll leave it as today's date for Google, and then you just make whatever changes you need to it. The boxes in yellow are the ones you would put data into, and the boxes in white are formulas, so just let them calculate themselves. And then trading days in a year, there's 250 days that the stock market's open in a year. So now it's just how many days. So I'm calculating time by how many days the stock market's open till your option comes up, divided by how many days the stock market's open per year. So that will give us now a percentage of how much time, this is how many years in time that the stock market's open. So it's how many years until the stock market, the percentage of years until the stock market, until your option expires. And then we could also add in a dividend if we wanted to. But Google happens to be a stock with no dividend. So, so we put 0 for the dividend, and then we calculate D1 and D2, and then from that we can calculate the put and the call. I think the formulas were something about a normal distribute. So we take the current price times, there's an Excel function, norm S distribution, and that does the Z, you give it the Z-score, the number that you want a unit normal computed on, which would be, in this case, D1. So it's the unit normal, it gives you the Z-score of D1, and then minus C4 ends up being the strike price times, the strike price discounted by negative the rate times the remaining time times the Z-score of D2. Okay, so we can calculate the put and the calls. Once we have the dates typed in, we can calculate the values of the puts and the calls. So if we're using the Treasury US Treasury, so for the next 3 months, 3.5 months or so, we're looking at, let's say, a 0.003% interest rate. This is how much time until it expires. We don't know what the volatility is. Like, in other words, if you were pricing options, what would you use as the volatility for the next 3 months for Google? Would you use the past 3 months? So the volatility ends up being, since the volatility is the square root of the variance, the volatility would be like 1 unit of deviation away from the median. So you could look at the past, you could say, on average, I would expect it to be 31% away from the median, because that's how much it's been fluctuating in the past. But if you wanted to know what's going to be the volatility of the future, what could you do? I guess you could look at the past, but there could have been news about in the past that made it very volatile, and now all of a sudden the company's kind of settled and probably won't be fluctuating as much, so maybe the past doesn't work as much. But we can figure out, right, so does that make sense, that the interest rates we know, the US government posts them, it tells you if you buy bonds today, you will get this yield. So you know that's going to be the rate. You know the time until it expires. Of course, today is December 7th and it expires on March 16th. You know exactly how much time until it expires. You know the current price, because the stock market publishes it every day when the market closes, and you know the strike price. The only thing we don't know is the volatility. So, people are buying and selling these options today, and the closing price today, what was the closing price? The closing, there is an answer. So all of these fields are the inputs to calculating the call price. And one of them we don't know is the volatility. There's no website telling us the volatility. But the price of the option, the 650, closed today at $20.50. So apparently the people who are buying and selling these have met at that price, $27.50. So if we want to know what is the volatility that the world thinks this stock has, we'd have to kind of reverse engineer this, right?
Go seek it.
Yeah, so what we're trying to solve is, all of these inputs, and including the dates, if you input all the yellow boxes, this will come out. Now we know this, 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 and this, but don't know this input. However, we know the answer. So anytime in Excel, when you punch in formulas, one set of formulas, one box equals 2 other boxes with a formula, and then those merge into other boxes. What you can do is use this tool called goal seek, which is basically saying, I want the answer to be something. What does one of my inputs have to be to get that answer? So with goal seek, we can figure out what the volatility is. Because we know the answer, we just don't know one of the inputs. So the way goal seek works is, you say, data, and then you go to what if analysis, and then you pick goal seek. So from goal seek, we can say, I want this box to equal 2750, and then of all my inputs, you're allowed to vary one of them. So I'm going to click on the volatility. So basically what I'm doing here, if you haven't seen goal seek before, so basically what I'm doing here is I'm saying, I want the answer, the call price, to be, I want this box to become 2750. And the thing that calculates this box are all the yellow boxes get all put together and then turned into formulas. These actually turn into this formula, and then this formula is built on these formulas, so it's a kind of chain of formulas. But I'm saying I'm telling Excel to allow this box to become whatever it needs to be to make this box 2750. So after I hit OK, we'll know what the implied volatility is. Okay, so what this is saying is, based on the data from the markets, in order to get this to be 2750, the volatility had to be 0.2856. So the real world market, assuming the Black-Scholes model is legitimate and being followed, the real world market thinks that Google, between now and March, a good estimate for its volatility would be 28%. Now, that's 28% per year. So the expected value is after a year, it will deviate 28% off of wherever its current price is, going up at the normal interest rate. It'll then, it's expected to deviate 28% from that. So that's a pretty high volatility stock. Now, if we did the same thing, so what I did over here, let me make sure I got this right. Which one did I get? The 650. 2750. Let me change that to 28. Okay. Okay, so basically what I was doing here was just I took some sample strike prices and put the volatilities down. Okay, so basically the same exercise I just did with GoldSeek, I did it 5 times and just wrote the data down here. So now here's an interesting question. Would you expect, since they're all March, they all expire in the middle of March, I'm just using different strike prices, what would you expect the volatilities to be in connection with each other? So basically the people who are in the market for buying a strike price of 650, Google call for March, right? The current price is 623.39.
It's gonna be lower.
Well, the volatility, in their mind, what they think the volatility is going to be, contributed to this price, this 2750 price, right? Right, if it's not volatile at all, the strike price would be 0, and the more volatile it is, the higher the price of the option would be. Because the more volatile it is, the more likely you'll become rich buying it. So the volatility affects the price. Now apparently they're taking, the market is, to come up with this price of 2750, which was the last sale at 4 o'clock today, they had to take all of this information into account. The current interest rate, how much time till it expires, the strike price, all this stuff had to be taken into account, and one of the things they're somehow taking into account is the volatility. How volatile they think it will be from now until March. Now if a different group of people come, or maybe it's even the same people, and they're looking at strike prices of 550, should their volatility be different than the 650 people's volatility? You know, like, in other words, it's a theory versus practice question. What's the volatility? So, the strike price of 650 is saying between today, December 7th, and March 16th, it is expected that the volatility of this stock will be 0.28% per year. That's how volatile it will be. Now all of a sudden they're calculating a 550 option and saying, well, if I'm pricing a 550 option, apparently they're using a higher volatility. Is there any intuitive reason why you think it might be a different volatility? Or does I guess kind of what I'm getting at is, would you think that these would all be the same? Because what they're taking a guess at is how volatile the stock would be between today and March 16th. On the same stock, with the same expiration, would you expect the volatilities to be the same, or can you think of an explanation why they might be, they are a little bit different? So why would they be coming out different? Anyone, just any intuition? So is there any reason why, well, what would be the intuition? Would you think it would be exactly the same? Or do you think that, is there an explanation for why they might be different?
Well, I mean, if you look at it, when the strike is increasing, volatility is decreasing, pretty much.
Right, it looks like for equities, it's kind of going down as the strike price goes out into the future. So you really need like the stock to go way up before you start
Yeah,
making
because you're not
money.
gonna, if you ever buy a call for the 700 strike, you're not gonna make money right away, because you're out of the money.
Right, so it would certainly make sense that the prices would drop.
Right.
The,
Yeah.
But with what about the volatility dropping? Would you
Yeah.
expect as part of the input, the implied volatility, it's kind of like the people saying, if two people got together and said, hey, I'm thinking of buying, would you like to be the seller of an option? I'd like to be the buyer of an option with the strike price. And you see that number of 650, you're saying to yourself, well, at that price, I think the stock, I'm going to consider the stock less volatile. At that strike price, I'm going to consider the stock less volatile. But if you want to get into a contract with me for $5.50, I'm going to consider the stock to be more volatile. Does that make sense or not?
Yeah, because then the cost is going to be more to you, and the volatility will raise an increase in the volatility would raise the cost, because now you're in the money, and you're.
So you would expect the volatility parameter, the implied thing that the people are just kind of taking in, kind of in their head, the volatility, their mind would say, I want to consider this a more volatile stock because you're getting very close to being in the money.
Right.
Okay, that does intuitively does that make sense to other people? I mean, what I initially, the first time I ever saw this, and the whole reason why there's a chapter in a textbook, I think the name of the chapter is Volatility Smile, is I think a lot of people's intuition might be that these should all be the same. It's the same stock, same time expiration, so we're using the same interest rate, same time, everything's staying the same, it's just the strike price is changing. So if there was a parameter that says, well, over the next 4 months I expect oil to be this volatile, why would that change? Volatility is volatility. So I think the reason they put a whole chapter on it, just what they're really pointing out is these numbers are different. And some of it has to do with, like what you're saying, it's human nature, that human, like we talked about earlier, if you said to somebody, would you like to have $1 million or would you like to have a 50-50 chance of winning $4 million, the risk neutral thing to do would be to flip the coin and try to win the $4 million because it has an expected payoff of $2 million, but people say, no, I'd rather just take the $1 million. So it's kind of like, what's going on is as the price is getting closer to in the money value, the price you want to charge the person, really for being on the losing end of the contract, would be a higher price.
Right.
So it starts to move the implied volatility.
But then the volatility dips.
Right.
When you get to 500.
Yeah.
That's why it's smile. That's why it smiles, right?
Yeah. So the graph for this one, if we wanted to draw a graph of this, it would be, so you can graph in Excel by, I think you just shade a region. I think it even knows to put these words as the axis. So
Like a scatter plot.
is it insert? Scatter. Something like that. Yeah, so this graph is coming out like this. And this isn't really a smile, but basically, so some people's intuition might be the volatility, since these are just the strike prices, and the current price is somewhere around 623. It's probably somewhere around here. what do we have? What was updated? 700, 650, 600. So somewhere in here is the strike price. And it looks like the curve, changes its pitch right around the current price of the stock. But the idea, the point we're just trying to point out here, not only so we know how to now calculate the implied volatility of a real stock from the real market, it also shows that the volatility is not the same. The implied volatility changes with the strike price. Intuition tells you it's the same stock, it's Google stock for the next 3 months. Why does one person think it's more volatile than another? And the implied volatility in our calculation changes as the nervousness of the person changes in writing that option. So, and then if you wanted to, you could do, go back on. So yeah, so this ended up being the curve for today, for Google stock for today. And I don't know if you would even consider that a smile. It's just letting you know it's not a flat line. Intuition might cause a lot of people to think it's a flat line, but the chapter in the book is pointing out that for different strike prices, there's different implied volatilities.
You probably need more data for a smile.
To make it look like a smile?
Yeah, probably
Yeah.
more.
Yeah, that's true. Yeah, maybe we could. Yeah, maybe we could. Yeah, if you want, we could take the last couple of minutes and just put in. You think using more strike prices and just plot it, and see what happens? Okay, and then the other thing is, if you think about it, so that curve is in 2 dimensions. You can add more dimensions to this. Once you get into a 3rd dimension, it starts to become a surface, not a curve. But we could map the delta. So if you remember, the delta was the change in the stock price with respect to the change of the stock price with respect to the change in the option, and then days to maturity, and then the z-axis would be the implied volatility. So now it ends up being, because it's 3 dimensions, it ends up being a surface. And the surface, it kind of has the same behavior that it's a 3-dimensional picture, but it's kind of working its way up to here, and then at a certain point it starts curving down again. So now a whole science is to come up with a function for this surface, or for that volatility curve. So if you want to price a series of options, if you work at a financial company, and you want to know what does our company want to pay for Google options at various prices, well, you'd have to somehow come up with, your secret sauce for pricing options would be, what do you think the volatility is? Everyone knows everyone's using the same interest rates, everyone's using the same time to expiration, everyone's using the current stock price, everyone's using the same strike prices. It's the ones the market gives you. You're coming up with what you think the volatility is. So you're coming up with some way of finding this surface, and then saying, based on this surface, here's what we think the prices are, and when the prices go a little bit higher, you sell, and when they go a little bit lower, you buy. And if you can predict this surface better than the other financial firms, you could make small amounts of money trading against them. But that's like the big secret. That's the one parameter nobody knows the right answer to. We're all guessing at this one. Okay, so let's see, if we did a couple of other, we have a few minutes left. So if we did a couple of other calculations, let me get rid of this one. So what would be good ones to add? $7.50, so $3.70. So you think we should do like one more and two before?
Yeah, I think that'd be fine.
Okay. So, yeah, it's just curious to see what the curve will look like. And then what, you said 450?
146.20.
And then the 400 is 221.10. Okay, so for the strike price of 450, right, we just put the strike price in, and then we do gold seed. We want this box, data, gold seed. We want that box to equal 146.20. By letting this box change. What's going on?
Yeah, sometimes gold see badly.
9 times 10 to the 11? That's a crazy volatility.
The call's at $623. Doesn't have a solution for it.
Yeah, it's not solving it then. Okay.
What if you made the volatility 0? What?
No, that's times 10 to the positive.
Oh, negative.
Yeah, it's an incredibly high volatility. All right, well, let's pretend we didn't do that one. This one should just get lower, right?
750, yeah.
That should just get lower. So let's see.
It's weird that put is 7 cents.
So let's see, at a strike price of $7.50. And then we do gold seed. So what is gold seed? This box become 750. I'm doing this. Again, it's yeah, I can't calculate that far out. Yeah.
Do we want the target value to be $3.70?
Oh yeah.
Yeah.
What did I put? Sorry. This did I put? Okay.
Why is the put in the call? Like, it just looks really.
Okay, so we want to set this cell to 370.
Yeah.
What did I put last time?
750.
Oh,
By changing so.
7.5?
No, 750.
Oh, okay. And by changing cell volatility. Okay, yeah, that was more expected. So 25, so this is just going lower. It's gonna keep curving downward. So the other one went over a hump and then well, I don't know if Excel's just not calculating it correctly.
Why is the put so big though? That doesn't even, like the call price and the put price are just so different. Because the current price is 623.
Yeah, because it's not very likely, this being very low is because it's not likely you'll go above 750. And the put is already 100, $750 minus
Oh, it's
60.
already in the money for the.
Yeah, it's
for the put.
$126 in the
Oh, I
money.
see, yeah.
So, yeah, so, and you're also paying like an extra $3 or $4 just to have it, just like have, you know. Oh, actually, I'm curious if the puts, do the puts match? So, 129.65, so according to put call parity, these are calls, right? Then we switch to puts.
Could be on the bottom.
Now, the 750 put selling for 131. And according to us, it should be 129.65. That could be because those are such spread out prices that they don't sell that often. Like one could be at 4 o'clock and the last one went, the other one went through at 2 o'clock. So, but put call parity, you know, we should be able, whichever, that equation I had where I said the Black-Scholes difference and the market difference should match, those should have matched. So that might be just so that price is so high, they're so far apart that the two most recent sales were not done around the same time as each other.